Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 60, I'm going to branch out a little bit into some international tax issues, and we're going to look at some new rules surrounding the disposition of a U.S. partnership interest by a foreign taxpayer. Now, I highlight this to say new rules just because these aren't necessarily new rules, but these have been brought front of mind by the Department of the Treasury recently proposing some new regulations that are going to refine these rules. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, in the Tax Cuts and Jobs Act, which seems ancient now, given everything that's gone on in the world and the possibility of more tax changes on the horizon, there are a couple code sections added which really mirror FIRPTA, but extend really the application of FIRPTA to the realm of partnerships in general. Now, just to set the stage, the U.S. generally can't tax foreign persons unless those foreign persons receive U.S. source income. And the type of income that's usually subject to tax would be one, portfolio income, which is things like interest, dividends, rents, royalties, those types of passive incomes. Now, a foreign person could also have income that's effectively connected with the conduct of a U.S. trade or business. So usually income coming through an entity that conducts a U.S. trade or business could be treated as what's known as ECI, effectively connected income. And what the IRS has done here is they now tax the gain or loss on the disposition of a U.S. partnership interest by a non-resident alien individual or a foreign corporation. And that gain or loss will be taxed as ECI, effectively connected income, which is similar to FIRPTA in that a foreign owner of U.S. real estate also is subject to a similar tax. Now, with FIRPTA and with this new partnership rule, the context under which we're going to really look at this isn't necessarily any problem for the seller. It's more problems for the buyer, because what this new regime imposes is a withholding requirement where if a buyer purchases a partnership interest from a foreign partner, the buyer has to withhold 10% of the purchase price and submit that to the IRS as a proposed tax, and then that leaves the seller on the back end to go seek a refund from the IRS if that 10% is greater than the actual tax that the buyer or that the seller is liable for. So it's this withholding requirement that can be imposed even on a U.S. taxpayer or a U.S. partner or partnership that we have to be concerned with here. So there are proposed regulations floating out there that have been proposed by Treasury that are going to kind of fill in some blanks here. And there's no way we could do these justice in the short time we have in this talk. Now, there are some areas where I can't necessarily guarantee this, but there should be light shed on some general terms and procedures in terms of the withholding requirement and the meaning of disposition, and also, similar to FIRPTA, the existence of some look-through rules for how entities in estate planning, like trusts and estates and partnerships and other parties, as buyers and sellers, could be treated under the tax or withholding requirements here. But for the time being, there are some things to keep in mind when it comes to estate planning and tax planning around partnerships. And one is that this used to be something you only had to be concerned with real estate transactions, and it was an overprotective thing that was baked into any sort of real estate sale. But this is also going to be something that I think on the conservative end now has to be baked into any sort of transaction where an interest in a partnership is sold, and that is a non-foreign affidavit. So the transferee, as I mentioned, usually the buyer, would have to withhold 10% of the purchase price being paid as a proposed tax on the transfer. And if the transferee doesn't do so, the partnership has to do so. Now, we won't get into the consequences of what happens if there is no withholding, but what's usually good practice in a real estate transaction, and now would be good practice in a partnership transaction dealing with the sale of a partnership interest, would be to have the seller execute what's known as a non-foreign affidavit. So what that means is that the seller of the partnership interest has to sign maybe a one-paragraph thing where they represent that they are not a non-resident alien or a foreign corporation for purposes of the partnership disposition, and in doing so, that relieves the transferee within certain bounds of their withholding liability. So, as I said, this is a maybe overly conservative, but I think the good practice from now on would be to include this in any sort of partnership disposition, even if the parties on both sides are U.S. taxpayers or U.S. citizens or residents. Now, arguably, this couldn't apply to a gift because there's no sales price to withhold, but any sort of sales transaction could be subject to this rule. So our key takeaways here are going to be that we're concerned with transferee liability for withholding and not the liability of the seller in this case. So with any partnership disposition, it might be a good idea in the sale documents, one, to include the proper language requiring a non-foreign affidavit to be issued to the buyer or the transferee in this case, so that the transferee can be at least relieved to a certain extent of the withholding requirement. Now the following are some but not all of the areas where this could apply. We could have a sale of a partnership interest to a child or to another entity or a business partner, maybe under a buy-sell agreement. There could be a gift to a foreign trust or a sale of a partnership interest to a foreign trust. In any sort of case where we have these potentials, we're going to be concerned with does this new withholding regime apply? And I also want to highlight too to be careful with sales to grantor trusts, because these could be muddied, especially with this new rule and in a case where the grantor is a non-resident alien individual. But that's a topic for another time. I'm going to go ahead and cut this presentation short and wrap up. So as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. If you have the time and the stomach, go check out the new regulations we talked about. But if not, thank you for joining me for this episode of the 10th of an Hour, and I look forward to seeing you in the next one.